This chart shows the overall weighting of top 10% largest US stocks going back to the 1930s. Today they make up about 75% of the entire index, one of the highest levels ever. This is a great historical representation of the underlying theme we talked about earlier of a handful of corporations eating up a larger and larger portion of the economy. And we've seen similar moments before. In the 1920s, it was the big industrials and utilities. In the 1960s, it was a group of 50 large caps stocks called the Nifty 50. In the 1990s, it was dot-com companies. Each of these peaks marked moments where a handful of companies were dominating the economy. All of them were reversed. Since 1990, we've been in a structural uptrend with market concentration steadily increasing, and more recently, this has steepened and reached the highest level since the Great Depression. Some speculate that AI will push the large companies towards even more domination in the coming years, but others suggest we could see at least a temporary reversal here. This chart shows the valuations of large cap companies and small cap ones. There's a historical gap between the two. The S&P 500 trades at 22.2 times earnings, while the small cap S&P 600 sits at just 15 times. This is typically the first criteria that we tend to see when concentration is reversed. Some analysts note that large caps may have less room to expand, while small caps appear comparatively lower in valuation. But textbooks always say valuation aren't a timing tool. The gap has been like this since 2020. What if it just continues like this? And you would absolutely be correct in pointing that out. This valuation gap we're seeing now could just stay wide for long periods in the future. There needs to be some kind of a catalyst to drive valuations up or down. There needs to be some kind of a shift in the underlying fundamental story that changes how investors think about how attractive the smaller companies are relative to the larger ones. And some analysts have pointed to a few such factors. First of all, after 3 years of stagnation, small cap profit margins are finally ticking higher. Since 2024, margins in the S&P 600 have climbed from around 6% to nearly 7%, a 15% improvement. Profit margins are one of the clearest leading indicators of future growth. When they rise, it means companies are regaining pricing power, cutting costs, and freeing up more capital to reinvest back into their business. These kinds of improvements are often seen as strengthening fundamentals.